Everyone's excited. Markets are hot. Tech is booming. Money feels easy again. And right in the middle of all that noise, Warren Buffett quietly sold over $4 billion. Now most people are asking, what stocks did he sell? What does he know? But the smarter question is this. What would Rockefeller have done? Because Buffett plays the game with logic. Rockefeller? He designed the game itself. Buffett trims his portfolio when valuations run high. Rockefeller didn't trim, he consolidated. He didn't just reduce risk, he eliminated variables. One plays chess with capital, the other owned the board. So yes, Buffett is making moves. But what if those moves are reactive? What if Rockefeller wouldn't just sell positions, but restructure the entire ecosystem to make it obey him? In this video, we'll break down exactly what Buffett sold, why he sold, and how Rockefeller would have made a more powerful move. This isn't about who's better. It's about how power thinks differently. When you're aiming to build, not just bet. Let's get into it. What Buffett sold? Warren Buffett just sold off or trimmed over $435 billion in stock. And here's what most people miss. Buffett rarely sells. When he does, it's never random. Let's start with the exits. Citigroup, gone. All 14.6 million shares, worth over $1.1 billion, wiped clean. Why? Because the business was underperforming. Low return on equity, bloated costs, and no sign of a turnaround. Buffett bet on a recovery in 2022. It never came. Rockefeller would agree. If the asset doesn't deliver, cut the loss and reallocate. Nubank, exit, a trendy fintech from Brazil. Great hype, poor fundamentals. 40 million shares sold, nearly $500 million. Inflation, instability, and poor earnings. Buffett cut it loose. Bank of America, major trim. Buffett sold over 48 million shares, $2.1 billion worth. Still, holds a big stake, but macro headwinds and low upside made it less attractive. Interest margins are tightening. Consumer credit is weakening. Buffett cashed in while it was still strong. Liberty Media, Formula One, trimmed. High brand equity, but profits stalled. Buffett sold over $300 million worth. Why? Growth plateaued. Debt's high. Monetization is slowing. Classic move. Strong name. Weak numbers. Take profits. Reposition. T-Mobile, trimmed. Sold nearly. $113 million worth. Still a leader in telecom, but growth has slowed. Buffett doesn't like paying premium prices for slow-growth companies. Capital One, reduced. About 300,000 shares sold. $56 million. Risk, consumer debt is rising. Credit, quality is slipping. Buffett's protecting the downside. So what's the pattern? It's not panic, it's precision. Buffett is pulling capital out of businesses where the risk-reward ratio no longer makes sense. He's not scared. He's preparing, and that's where Rockefeller would ask, why let the risk exist in the first place? What Buffett bought. So, where did Buffett move that $4 billion? He didn't go all in on AI. He didn't chase tech unicorns or ride the crypto hype. Instead, he went boring, but brilliant. Constellation Brands, $1.17 billion. Owns Corona, Modelo, Robert Mondavi. Why? Because when the economy slows, people still drink. High margins, stable demand, PE around 14. That's Buffett's kind of value. Occidental Petroleum, more added. Buffett now owns nearly 28% of the company. Strong free cash flow, debt being paid down, inflation resilience. He's betting on energy security and cash flow dominance. SiriusXM, $58 million added. Down over 60% from its highs, but still printing $1 billion in cash flow annually. It's a cash machine nobody's watching. Buffett's move? Classic contrarian. Domino's Pizza, $113 million. But not because of pizza, because of logistics. 40% of orders are digital. International expansion, high brand loyalty, scalable, predictable, safe. 5. Pool Corp, $260 million. They distribute pool and outdoor equipment. Boring? Yes, but it's a niche with pricing power and high repeat customers. Minimal competition, maximum margin control. VeriSign, small ad. They run the .com and .net infrastructure. Think, internet plumbing, stable, quiet, 70% operating margin, rock-solid cash flow. So what's the theme? Cash flow, predictability, valuation. Buffett is repositioning away from fragile, hype-driven sectors and into steady, cash-rich businesses that thrive in uncertainty. He's not scared. He's strategic, and Rockefeller would have respected that, but he wouldn't stop there. Where Buffett stops, Rockefeller begins. Here's where it gets interesting. Buffett is a master of value. He allocates based on price, performance, and downside risk. But Rockefeller, he didn't just buy value, he built systems that created value. Buffett trims when risk rises. Rockefeller tightened control until risk had nowhere to go. Buffett holds cash when no deal looks attractive. Rockefeller used cash to shape the deal itself. Buffett optimizes returns. Rockefeller organized industries. Here's the core difference. Buffett is an investor. Rockefeller was a builder of environments. Buffett sees a good company and evaluates its upside. Rockefeller sees an entire supply chain and takes it. Buffett buys cash flow. Rockefeller creates it. Buffett reacts to overvaluation. Rockefeller engineers pricing power through market dominance. When Buffett sees inefficiency, he exits. Rockefeller sees inefficiency and takes control to fix it. That's how Standard Oil became untouchable. So what's the lesson? Buffett waits for opportunity. Rockefeller builds it. And in today's market, where noise is everywhere and clarity is rare, you don't just need to know what to buy. You need to think like the man who made money bend to his will. Buffett teaches us discipline. Rockefeller teaches us direction. Discipline says, don't risk it. Direction says, own the outcome. And brother, that's the difference between playing smart and playing to dominate. What Rockefeller would do in this market. Let's imagine Rockefeller was alive today, looking at inflation, record-high consumer debt, and inflated tech valuations. He wouldn't panic. He wouldn't chase. He'd build leverage quietly. While Buffett sells overpriced assets, Rockefeller would ask, who controls the distribution here? Who owns the process others depend on? He'd be acquiring logistics businesses, essential infrastructure, undervalued service providers that other companies need to function, not for trend, but for control. If a stock becomes too expensive, Buffett trims. Rockefeller? He'd look for the supplier, the back-end operator, the choke point. He'd use cash not just to buy assets, but to secure positions in the system where money always flows. For example, he wouldn't just buy Domino stock. He'd invest in the tech that powers online ordering across the entire food industry. He wouldn't chase energy plays. He'd lock up transport lanes, pipelines, or critical minerals for decades. He wouldn't wait for correction. He'd create his own terms through joint ventures, regulation influence, or acquisition of bottlenecks. Rockefeller didn't wait for discounts. He created them by becoming the only option. Lessons you can apply today. Like them, especially Rockefeller. Here's how. 1. Control before scale. Don't chase the shiny opportunity. Look for what others depend on and get your position there. Whether it's a digital tool, niche skill, or product, find the leverage point in the system and own it. 2. Hold cash. But don't wait. Cash isn't for comfort. It's a weapon. Rockefeller used liquidity to create timing power, not to wait for deals, but to make the terms. Keep liquidity, not to feel safe, but to move fast when others can't. 3. Think systems. Not stocks. You're not here to pick winners. You're here to build positioning. Start asking, what part of the system am I in? Who pays me? And who do they depend on? How can I move closer to the core of control? 4. Reinvest in your control. Buffett buys what's undervalued. Rockefeller reinvested profits to increase control. Not just dividends, but more ownership, more efficiency, more dependency. Take your wins and use them to eliminate randomness in your world. Rockefeller didn't need hype. He needed leverage. And today, in a noisy, overvalued, over-leveraged world, that's still the winning move. Don't just watch the game, control the board. Here's the truth. Buffett plays the game brilliantly. He trims, he waits, he repositions. He protects capital like a general protects troops. But Rockefeller, he wasn't just protecting. He was advancing, always. He didn't need perfect timing. He built environments where the odds were already in his favor. And that's your challenge today. Don't just think like a smart investor. Think like a strategic founder of your own wealth system, because the world you're living in, it's full of distractions, hype, and momentum chasers. But the real ones, the builders, the architects of wealth, they're quiet, they're patient, and they're intentional. So ask yourself, are you reacting to the noise, or are you building your own code? Rockefeller didn't follow the market, he shaped it. Now it's your turn to do the same. Don't just hold cash, build position. Don't just diversify, build control. Don't just wait, lead. This is Rockefeller's advice, where money meets purpose, where strategy replaces stress, where you don't just play the game, you own the board.